what is your reaction just to investors getting spooked by the action that we saw in the bond market over the last couple of weeks as we saw the rapid rise in yields? And how are you advising and how are you playing the market right now?
Well, I'm telling everybody to get a neck brace. I mean, you can really hurt your neck from watching the volatility in this market. But look, I think what's happening here is we went from 0.52% in the 10-year U.S. Treasury bond yield back in early August of last year, and we got as high as 1.6% just in the past few days. But now suddenly it looks as though the bond market's settling down after that big run-up in yields. And maybe we'll just see it kind of rest here for a little while at 1.5%. If that's the case, then obviously the stocks that got most spooked by the increase in bond yields will say, well, 1.5% is not so bad. And it's actually where rates were right before the pandemic. What's the big deal? And suddenly all these stocks that got whacked with the NASDAQ down 10% correction look attractive again. So I think that's what's happening. I think also people are figuring out that there's $1,400 checks coming. And while that may obviously go a long ways in stimulating an even stronger economy, some of that cash is going to go straight into the stock market.
Ed, the bond vigilantes are just reloading. We still have another week before the FOMC meeting. You, in a recent note to your clients, actually spelled out very clearly something that I'd like you to spell out for the rest of us, which
Sure.
is the spread between the 10-year and TIPS, and why what we're witnessing here really is, as you just said, what's the big deal?
Well, that spread is basically a proxy for expected inflation over the next 10 years. And it's, I think it got as low as 0.5% last year when people were projecting that the pandemic would cause a terrible long recession and wouldn't be over for quite some time. And now we're up at over 2%, 2.3% last time I looked. So that sounds like inflation's making a big comeback, but 2.3%, we've been here before without inflation even going above 2% when you look at consumer prices. So all in all, I do think we're going to see some pickup in inflation, but I find myself agreeing with Fed officials that it's probably going to be transient. And that's mostly because I think productivity is making a huge comeback.
And you mentioned before that we have to get a neck brace here, just looking at all this volatile action that we've seen in the market. When you take a look at some of those big tech names or some of those growth names that had fallen out of favor before today, are they oversold, at least on a short-term basis?
Well, I think they were yesterday. Right now, not so much. I mean, a lot of them are up 4, 5, 6%. So they've recovered pretty quickly. So clearly the market in today's action is saying that they were oversold. But I still see value there. And I think the market has really been broadening out ever since early September of last year. That's when we first started to discount the likelihood that vaccines would be coming, and vaccines were announced in November and have been distributed ever since December. And I think we are getting back to a semblance of normal. But what's not normal is the amount of fiscal and monetary stimulus. And I think the stock market's kind of in a tug of war between, well, that means higher bond yields, doesn't it, and higher inflation. But on the other hand, it means higher earnings. And it also means there's a lot of cash out there to buy stocks. So I'm in the bullish camp. I still am. And I think we had a little correction here on some concerns about interest rates. I think we're okay.
So share with us, what is the bottom line on panic attack number 69, growth versus value rotation, if all that money is about to buy equities?
Well, I think we should explain to your audience what we mean by that. I've been counting these panic attacks since the beginning of the bull market. I've been keeping a diary of them. We actually have it posted on our website. And this latest sell-off, this 10% correction in the NASDAQ, we count that as panic attack number 69, and we try to assign them short little blurbs of what caused them. And this one is clearly caused by the surprisingly fast backup in bond yields. Not surprising that it's going up. And so I think we're back in rally mode, and next thing that'll happen in my diary will be panic attack number 70, and that could be May. I mean, I could see a scenario where we have a melt up here in April with all the cash that's coming into the market. Then ask me again, but it's conceivable that this time may actually be a good time to go away if we get too much activity, too much to the upside in April.
Hey, Ed, real quick, and you mentioned this, just that you expect some of that stimulus money to get fed back into the market. I want to ask you, though, Do you think a $2 trillion size package is necessary at this point? Not only, I guess, if you take a look at the market action, no, but more on an economic basis. Does the economy need a $2 trillion package?
Look, there's no doubt that there's people out there that are still suffering, and they need some help, and that's fine. And it would have been better if we just targeted money for those people, just for their pandemic needs, and small businesses for their pandemic needs. I think there's a lot in this plan that really isn't necessary, and it's going to be financed all with deficits. So the short answer is real GDP is going to be back to where it was right before the pandemic at a record high during the fourth quarter of 2019. That's where we're going to be when the first quarter numbers come out. That's how strong this quarter has been, as well as the previous quarter. So from a real GDP standpoint, we have fully recovered. And I think they're overstimulating the economy. But look, they want to get to maximum full employment by next year. This is making my head spin, in addition to giving me some neck pain. I've never seen anything like it. The shortest severe recession ever, followed by an amazing V-shaped recovery with an entire business cycle complete next year at full employment.
Well, it is nothing like any of us have ever seen before, and we really appreciate you taking the time to join us and try to help us make sense of all this. Ed Yardeni, always great to talk to you, and we'll have you back very soon.